Introducing a beginner's manual on technical analysis, a comprehensive video series tailored specifically for those who are new to the world of trading. Whether you're just starting out or looking to deepen your understanding, this series is your roadmap to success. Throughout this series, we'll cover everything you need to know to get started with technical analysis. From understanding chart patterns to deciphering key indicators, each episode will equip you with the knowledge and skills necessary to make informed trading decisions. So, if you're ready to take the first step towards becoming a confident and successful trader, be sure to subscribe to our channel and hit that notification bell so you never miss an episode. Together, let's unlock the secrets of technical analysis and pave the way for your trading journey. Let's dive in. Hey traders, and welcome back to Risk with Purpose, your ultimate destination for learning to trade with confidence and precision. I'm Technical Tiffany, and in this lesson, we will delve into basic concepts of technical analysis, including trends, trend lines, and how to use them to identify market direction and spot potential trading opportunities. Let's dive in. Lesson 3. Basic Concepts of Technical Analysis. Welcome to Lesson 3 of Section 2, Basic Concepts of Technical Analysis. In this lesson, we will explore the fundamental concepts of trends and trend lines, essential components of technical analysis used to identify market direction and potential trading opportunities. A trend refers to the general direction in which the price of an asset moves over a period of time. Trends provide traders and investors with valuable insights into the underlying market dynamics and sentiment. Picture yourself out on the water, scanning the horizon for that perfect swell. That's what traders do. They're constantly on the lookout for the next big trend, riding the waves of momentum to profits. Now, just like waves in the ocean, trends in trading come in all shapes and sizes. There are the big, powerful waves that carry you for miles, the long-term trends that can last for months or even years. These are like bull markets, where prices steadily climb higher, lifting all boats along with them. Jumping on board one of these trends early can be like catching a ride on a rocket ship to financial success. Then there are the shorter, choppier waves, the intermediate-term trends that ebb and flow with the tides of market sentiment. These are like the waves you might find on a windy day, with plenty of ups and downs along the way. Traders who can navigate these waves with skill and precision can profit from the market's twists and turns, riding the waves of volatility to capture short-term gains. But just like the ocean, the markets can be unpredictable. Sometimes you'll catch a wave that takes you exactly where you want to go, and other times you'll wipe out and end up underwater. That's why it's important to have a plan and stick to it, whether you're riding a long-term trend or catching a quick wave on the intraday charts. And just like a surfer studies the weather patterns and swells to find the best waves, traders use technical analysis and market research to identify emerging trends and potential opportunities. Whether you're looking at moving averages, trend lines, or chart patterns, the goal is always the same: to catch the wave before it crests and ride it for as long as possible. There are 3 primary types of trends: uptrend, downtrend, and sideways trend or range-bound. Uptrend. An uptrend in the financial markets is like riding a wave of positivity. It's when the price of an asset keeps hitting higher highs and higher lows over a period of time. This tells us that buyers are in the driver's seat, eagerly pushing the price higher. So, why do we call them higher highs and higher lows? Well, each time the price hits a new peak, it's higher than the previous one. And when it dips, it doesn't fall as low as before. This shows us that even when the market takes a breather, buyers are still there, supporting the price and keeping the momentum going. Uptrends are exciting because they signal optimism and confidence among traders. It's like everyone's cheering for the same team, expecting the price to keep climbing. And as traders, we love to ride that wave, buying in and riding the trend upwards. Recognizing an uptrend is key because it helps us make smart decisions about when to jump in and join the party. Example: uptrends can be identified by a series of higher highs and higher lows. Downtrend. A downtrend in the financial markets is like hiking down a rocky slope. It's when the price of an asset keeps forming lower highs and lower lows over time. Imagine you're trekking down a series of hills, but each hill is a little lower than the one before it. So, why do we call them lower highs and lower lows? Well, think of the peaks as the high points and the valleys as the low points. In a downtrend, each time the price tries to bounce back, it doesn't quite reach as high as before. And when it dips, it ends up even lower than the previous low. It's like a game of limbo. How low can it go? Downtrends are like a rainy day in the market. They signal a gloomy outlook, with sellers calling the shots and pushing the price downwards. But hey, every cloud has a silver lining. As traders, we can use downtrends to our advantage by betting on falling prices or adjusting our strategies to protect our investments. Recognizing a downtrend is crucial for traders because it helps us make smart decisions about when to sell or stay out of the market. Example: downtrends can be identified by a series of lower highs and lower lows. Sideways trend. A sideways trend, also known as consolidation or ranging, is where the price of an asset moves within a relatively narrow range without forming significantly higher highs or lower lows. Instead of trending strongly upwards or downwards, the price bounces back and forth within a horizontal channel. During a sideways trend, buyers and sellers are in a sort of tug-of-war, with neither side gaining a significant advantage. The price may fluctuate within a certain range, but overall, it remains relatively stable without making decisive moves upwards or downwards. Sideways trends often occur after a period of strong uptrend or downtrend when the market takes a breather after a long run. It's like the calm before the storm or a pit stop during a race. While sideways trends may not offer the same opportunities for big profits as strong trends, they present their own set of trading opportunities. Traders can look for shorter-term patterns within the range, such as support and resistance levels, to identify potential buying and selling opportunities. Recognizing a sideways trend is important for traders because it helps them adjust their strategies accordingly. Instead of expecting big moves in one direction, traders may adopt range-bound strategies that capitalize on smaller price fluctuations within the range. By understanding how sideways trends work and using the right tools, traders can navigate the markets effectively and make decisions that align with the current market conditions. Example: in a sideways trend, the price of the asset bounces back and forth within a horizontal channel. Recognizing trends. So how can we determine whether a market is trending? Trends can be identified visually by examining price charts and looking for patterns of higher highs and higher lows in uptrends or lower highs and lower lows in downtrends. A trend line is a straight line drawn on a price chart that connects two or more significant highs or lows, helping to visualize the direction and strength of a trend. Drawing uptrend lines. An uptrend line is drawn by connecting two or more consecutive higher lows. It acts as a support level and indicates the upward momentum of the trend. Example: during an uptrend, a trend line is drawn by connecting two or more consecutive higher lows. Drawing downtrend lines. A downtrend line is drawn by connecting two or more consecutive lower highs. It acts as a resistance level and indicates the downward momentum of the trend. Example: during a downtrend, a trend line is drawn by connecting two or more consecutive lower highs. Validating trend lines. Trend lines are more reliable when validated by multiple touches or bounces off the line, confirming the significance of the trend. Validating trend lines is essential. Trend lines require validation to ensure their credibility. This validation process involves examining instances where the price interacts with the trend line, particularly through multiple touches or bounces. These validations serve several purposes. Firstly, they confirm the presence of a trend, strengthening the support or resistance provided by the trend line. Secondly, they enhance the reliability of the trend line as an indicator of market sentiment by demonstrating repeated market responses to specific price levels. Additionally, validations offer insights into market psychology, with frequent bounces off an upward trend line indicating strong bullish sentiment, for instance. Using trend lines in trading. Entry points. Traders often look to enter trades near uptrend lines in uptrends or downtrend lines in downtrends, anticipating a potential bounce or breakout. The rationale behind entering trades near these trend lines lies in the anticipation of potential price reactions. Traders anticipate that when prices approach the trend line, there may be either a bounce or a breakout. A bounce occurs when prices reverse direction after touching the trend line, while a breakout signifies a decisive move through the trend line. In most cases, traders entering trades near uptrend lines in uptrends aim to capitalize on potential bounces, expecting prices to continue rising after touching the uptrend line. Example: traders often look to enter trades near uptrend lines in uptrends or downtrend lines in downtrends, anticipating a potential bounce or breakout. Exit points. Trend lines can also be used to determine exit points for trades. A trader who enters a buy order to enter the market when price falls to the trend line can also use that same trend line to determine where a favorable exit point might be. Using the previous example, we can see that some favorable exit points can be found as price falls back to the trend line. Essentially, as price falls back to the trend line, traders seek to enter the market, placing their stop loss, exit, just on the other side of the trend line. By doing so, their risk is defined and capped. Example: as price falls back to the trend line, traders seek to enter the market, placing their stop loss, exit, just on the other side of the trend line. By doing so, their risk is defined and capped. Trend reversals. Breakouts or breakdowns of trend lines can signal potential trend reversals, providing opportunities for traders to adjust their positions accordingly. In financial markets, trends don't last forever. Trend reversals occur when the direction of the trend changes from upward to downward, bearish reversal, or from downward to upward, bullish reversal. Identifying these reversals is crucial for traders as they present opportunities to adjust their positions and capitalize on new market directions. Trend lines are invaluable tools for spotting potential trend reversals. When prices break out above a downtrend line or break down below an uptrend line, it can signal a potential reversal in the prevailing trend. These breakout or breakdown points serve as significant signals for traders to reassess their positions and potentially enter new trades in anticipation of the emerging trend. Example: trend reversals occur when the direction of the trend changes from upward to downward, bearish reversal, or from downward to upward, bullish reversal. Breakouts/breakdowns. Breakouts or breakdowns of trend lines are not standalone signals, but are often used in conjunction with other technical indicators to confirm potential trend reversals. Traders typically look for confirmation from factors such as volume, price patterns, and momentum indicators to validate the significance of the trendline break and increase the reliability of the reversal signal. When a trendline breakout or breakdown signals a potential trend reversal, traders have the opportunity to adjust their positions accordingly. For instance, if a bearish reversal is signaled by a breakdown below an uptrend line, traders holding long positions may consider closing their positions or even entering short positions to profit from the expected downward movement. Conversely, if a bullish reversal is signaled by a breakout above a downtrend line, traders may look to enter long positions to capitalize on the anticipated upward movement. As with any trading strategy, risk management is essential. Traders should always consider placing stop-loss orders to limit potential losses if the trade doesn't unfold as expected. And that's it. Thanks for watching our video on the basic concepts of technical analysis. We hope you found this video informative and useful. If you enjoyed this video, please give it a thumbs up and consider subscribing to our channel. Don't forget to hit the notification bell so you never miss an update. We love hearing from you. So if you have any questions, comments, or topics you'd like us to cover in future videos, leave a comment down below. You can also follow us on our social media platforms for more updates, tips, and discussions about trading and investing. The links are in the description below. Thanks for watching, and as always, happy trading. See you in the next video.